Welcome to the deep dive video update. This is a video that I do every week, and the context of deep dive means a little bit different than what you may think. I look at hundreds of charts every week, and I put those charts that are really saying something into the videos I do every day. Then, over the weekend, I look through all the charts and I go, what charts am I not using right now? And those I put into this video, and we have to dive deeper into these videos to see if they're actually telling us something. Then I also have some other charts that I have just in this particular video. A lot of informational things that we don't necessarily use to make decisions, but can still be helpful to know. This is being prepared for Tuesday, February 18th. The first chart is informational, and we just want to have an idea. Where is the VIX in a longer term range? When we're up in a higher range, that means the market's going down. When we're in a lower range, that means the market's going up. We're chopping around sideways right now, but overall we are in a lower range as the market has been going up. Also, this comes and goes out of the daily video at times. This is called the Ulcer Index. This is another sentiment gauge or fear gauge to see how people are feeling. And as the name implies, when this is going up, that probably means the market's going down, and the ulcer that people sometimes have to deal with, that tends to get a little more shaken up. And I only show this chart when we're above this moving average, and we're below it right now, as the VIX and other sentiment gauges have been dropping down a little bit, showing there's not a lot of fear in the market. I do another study called the correlation of the VIX to the S&P 500. Sometimes we might get some insight from this chart that we're not getting from other VIX studies that I do. And when I pay attention to this is when we're above the dashed line. That means the market's getting nervous. And we may not be picking this up in the VIX itself. Well, right now we're getting kind of a low reading. We were starting to go up a little bit, but we never got up to this dashed line. I look at this every day, but until it goes above the dash line, I don't include it in the daily video. This just means there's not a lot of fear in the market as well. And then we look at the VIX, and there's another indicator, which is called the VVIX or volatility of the VIX, and do a ratio between the two. Sometimes when this is really going up, the market's going down. When this is going down, the market's going up. We've just been trading sideways now for the last couple of years, so I haven't been showing this chart at all either. Then we want to keep an eye on the speed of the VIX, and I use an RSI based on 9 periods. I only show this chart when we're above the upper line or below the lower line here. That just means we're going up or down pretty fast with the VIX. We're a little bit below the midpoint right now, so I haven't been showing this chart. Then we look at the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index, and then plot a ratio between the two. What I usually follow is this red line. It's been going up as volatility in stocks has been outpacing the volatility in bonds lately, but it's not really telling us all that much. Sometimes when this is going down, the market can be going up, but there's other times when this red line can be going up and the market's going up too. So we have to get the context for what's happening here. We're going up a little bit right now, but we're not getting a lot of insight from this chart. And just for informational purposes, we set the low after being in that bear market in 2022, a cyclical bear market. That is a bear market that usually only lasts for maybe months to a year or two, versus a secular bear market, which can go on for a very long time. Well, we had a cyclical bear market back in 2022 in the bigger context of a secular bull market when we were going up. A lot of people were trying to call this a secular bear market at that time. It didn't work out that way. So just think secular is bigger, cyclical is shorter in duration. Well, we bottomed in October of 2022, and as of Friday's close, we're up 74.97% from that close. Then we started to go back up. We fell back. And since the low set in October 2023, we are up 49%. All right. Stockcharts.com has this thing called technical alerts, and I go through the daily alerts in the daily videos. What you see here are the alerts for the whole week. And they not only pick out the S&P, they pick out the NASDAQ, NASDAQ 100, different sectors of the S&P 500. And we can kind of get looking at the different colors here. Are we more negative or are we positive? And we start at the bottom and work our way up. This first one, actually the second from the bottom, this was Monday, right when the market opened, and the top one was on Friday, right not too long before the market closed. But this just gives us a visual idea if things are more positive or negative. Stockcharts.com also has another feature where they try to remove all the emotion from different charts. And I have 6 different indexes that I follow. Now, you can use this same basic approach with a stock, with a sector, and it gives you a score from 0 to 100. The higher the score, the better looking that particular index in this case, or you may apply it to a stock or a sector. Coming in first place are the QQQs. This is the NASDAQ 100. This is where the Magnificent Seven stocks are at, the mega cap stocks, the high tech stocks. And when this part of the market is doing better, the overall market does better because the stocks in the NASDAQ 100 are also in the S&P 500. Now, when this is really strong, it'll get up into the 90s. But right now, it's coming in with a score of 86.1. In second place is a newer index that I just added to this. I used to do 5 indexes, now I do 6. This is an ETF for the NASDAQ composite itself, which is a very broad market, tech-based for the most part index. And it's coming in second place at 84.3. In third place is what I focus on the most is the S&P 500. The accompanying ETF is the SPY, and that's coming in at 76.8. Then we have the Dow coming in at 76.9. The small caps at 44.1, really kind of disappointing now. They were supposed to be doing a lot better than what they have been doing. And the weakest index right now are the mid caps, coming in at 38.4. So it's the large caps, it's the mega caps, it's the tech stocks. Those are still what's really leading the market, according to what we see here. Then I have a short-term rainbow, and this is short-term because it starts with a 10-period moving average and goes to a 50-period moving average. And then I like to look at a long version of this just to get a bigger picture of the short-term time frame. And here we see that price is above all the lines. We were kind of jumbling around right now. We're not at an all-time high yet for the S&P, but we're really close. And so we're above this rainbow. The longer we can stay above the rainbow, the more these lines will smooth out and continue to go up. If we turn negative and fall down from the rainbow, we'll see more of a jumbled mess. And if we stay more negative, then the lines will start to roll over. Then this comes in and out of the daily video. I look at a 19-day and a 39-day advanced decline ratio. This chart is the short term, 19-day. Well, in the chart that I show, that's just based on price. This chart also breaks it out based on volume. And we're slightly above zero here with the advanced decline ratio based on price. And we're coming back and looking actually a little bit stronger with the advanced decline ratio based on volume. And I kind of show this. I haven't been showing a lot of the advanced decline charts because we're just chopping along sideways currently. And that includes this chart right now because we've not been trending with the S&P 500. We have an up day, things are looking more positive. We have a down day, things are looking more negative. Even though we're dancing around the all-time highs, we're not seeing an awful lot of conviction right now on an end of day basis. At this time, we're looking pretty good intraday, where if we have a gap lower, we see a lot of the smart money coming in and actually doing some buying. But we're not seeing that really carried through to our end of day charts. Okay, then I have a thing called the boom indicator, and I measure it according to a 20, 50, and 200-day moving average, short, intermediate, and long term. When price gets kind of far away from a moving average, it has a tendency to come back, and it goes boom, back to price. That's where the name originates from. And we can use this like an oscillator. This measures, okay, we're getting too far away, we might go in the opposite direction. Well, we're not getting an extreme reading currently with any of these moving averages. I only show it when we are getting some kind of an extreme reading. So that's why it hasn't been included in the videos. Intermediate term is another rainbow going from 50 periods up to 100 periods. And yeah, we've been chopping around a little bit here, but we haven't stayed down here for very long. And so these lines are still looking pretty flat and still having a tendency to go up. This means the intermediate term trend is still intact and it's positive. Bollinger Bands, there's a lot of different ways you can use Bollinger Bands. This is just one implementation. It's called the percent B indicator. It's when we close above or below the upper or lower Bollinger Band. We're not doing that right now. I only show this chart when we're getting some kind of an extreme reading. And we measure how far are we from the 200-day simple moving average. And really, this is for more informational purposes. Unless we start to get about 10 to 15% above the 200-day moving average, then we could start to look kind of extended. But now we're not getting that reading. So this is more for information right now. Then some other measurements going from the October 2023 low to Friday's high. This has us up 32.84%, a little bit different than the other calculation that I showed. And I also watched this when we're starting to have declines. Last summer, when we were really going up, and then we started to come back down, we just about got down to that 10% level. Well, that is the line in the sand between just a pullback and an actual correction. When we got close to that 10% level, the smart money started to come in and buy, and that pushed us up out of here. We were having another decline here, but we didn't fall down to that 10% level. So again, this is more informational. Unless it really starts to tell us something, then I might include it in the daily video. This is another momentum oscillator called the Connors RSI. It works very similar to a regular RSI, where if it's going up, it's positive, down, it's negative, and then we look for extreme positive or negative readings. We're just about at the midpoint right now, so we're not getting anything extreme there. Also, anchored moving averages, which are a variation of regular moving averages, where anchored moving averages try to project things looking forward. And because we've been in an uptrend, most of these anchored moving averages are drawn to lows when we have pullbacks, and we're above all the anchored moving averages for the time being. If we start to fall at some point, then I'll look for other lows here to say, okay, maybe this will be a point of support. The CMB composite, I was showing this back in January when we were getting extreme positive, but then we dropped back down out of that and we're underneath this black line. And I use this like an oscillator as well, looking for an extreme positive or negative reading, which we're not getting right now. We're keeping an eye on the 20 period moving average. That's the short term, and I include that in every video each day. We're also keeping an eye on the 50 period moving average in case we start to fall. When we did decline after CPI came out last week, the moving averages provided pretty good support, and we came close down to that 6,000 level. Well, we're also keeping an eye on the 100 period moving average, which we're kind of far away from that right now. It'll come back into the picture if we start to decline, but for the time being, since we're so far above it, I haven't been showing this one. We want to keep an eye on the S&P 100, which is improving over the last week. When I did these videos a week ago, a little bit concerned. The S&P 100 are the biggest stocks that make up the S&P 500. When they're leading the S&P 500, which they're back to looking like they're improving now, that's more positive for the S&P. If the S&P 100 stocks are underperforming, that can put the S&P under pressure or at least limit its ability to really go up. But we just look at this on a price basis to look for any kind of divergences that we're seeing, and we're not really seeing any right now. This did come in and out of the video over the week, both on the daily side and on the weekly side. This is a point and figure chart. Now, point and figure charts don't take time into account. It just says, okay, if it goes up by this amount, draw on an X. If it goes down this amount, by this amount, draw on an O. That could take a day, that could take a year, it could take a decade. And so there's really no time factor involved. We are coming back up to this previous high. When we got above the 6,100 level, that drew in some new X's here, and that's looking fairly positive. But we don't have a signal right now, and we didn't have anything after Friday because Friday was a pretty comatose day. We ended up being virtually unchanged. But we'll keep an eye on this and just see if there's any more action that is drawn in the upcoming week. Standard deviation, this measures the speed we're going up or down and over the last 10 periods. And we're below the moving average. So when we're below this blue line, I don't show it in the daily video. The mass index, this did generate a signal. When we go above the red dashed line, the blue line, and then back down below the red dashed line again, that's supposed to signal that there will be a reversal. Well, it got triggered, and then we've been chopping sideways ever since. So I stopped showing this in the daily video because the longer we get away from the signal, the more irrelevant it becomes. Also, this is what I was showing this for a while. This is the Pring bottom fisher, and it actually gave us a pretty good signal. It crossed over right before we saw this nice little run up here. Then we started going sideways after that. But we lost that signal. We dropped down below the red line, so I stopped showing this in the daily video as well. Here's a long-term rainbow going from 50 periods up to 250 periods. Even with the sideways action, the lines are still going up and prices above all the lines. The long-term trend is still positive. This is a long-term oscillator called a special K. We're above the red line. The reason I don't show this is we only get maybe one or two signals a year, if even that. And so why show this in every video? But we're positive here. Then this comes and goes out of the video. Now, we've been battling in the short term right now because we're not trending in the short and intermediate term. This is more of a longer term chart where it takes the 10-day average of the S&P 500 highs minus the lows. We spent most of 2024 up above this green line, which could mean that we're overbought. It can also mean that's showing good intermediate to somewhat long-term positive momentum. Will we drop down? We've been able to come back above 50, and we were looking a little better. We got up to the green line, but now we've been dropping back down lately. And because we're more focused on the short term right now, I haven't been including this chart in the daily videos. And we look at a weekly chart of the S&P on top and the German DAX. That's the biggest stock market in the EU. And we do a correlation between the two. Now, they're outperforming right now. Germany's setting all-time highs and looking pretty strong these days. And so the US market is actually lagging behind on a longer term basis. That's why we're seeing this correlation going down slightly. And support and resistance areas, Fibonacci retracements, since we're really close to the previous all-time high. When this chart really will come into play is if we see some declines. I'll readjust this if we set a new all-time high here, and I'll readjust the low, which I'm a little off right there. But these are just possible levels of support if we do start to see more of a significant decline. Ichimoku cloud, it's been positive now for quite some time. There's a number of different ways to use this. The green and red clouds, all they are moving averages that are then shifted forward and used as support when we're above and coming down, or resistance if we're going down and then bouncing back up. Well, there's some studies that are attached to this where the blue line is above the red line. That's positive. And then we follow the green line here, which is kind of hard to see because it gets jumbled in with the bar chart. But this is also positive as well. So you take all of this, the lines are positive, and price is above the cloud. So you mix all those things together, and this is looking positive. We don't see an awful lot of changes in this, so I haven't been showing it. And we're also getting confirmation that things are positive right now from other indicators. If we start to drop back down and hit this cloud, then that's when I'll start to show this chart again. And some broad market measures, I've mainly focused on the VIX, which is attached to the S&P 500. This is the Vixen. Gotta love that name. It's the volatility index for the NASDAQ 100. And I don't follow it as close, but I do look at it every day. But I don't include this in the daily video because my focus is mainly the S&P 500. Then we look at the S&P 500 on top, and then we look at a ratio between growth, the QQQs, and value, the diamonds or the Dow, and we see that there's a pretty strong correlation between the two. So again, this is more for information to show that the correlation is pretty strong. When the Qs are outperforming the diamonds, and this is going up, that means growth is still leading the market higher, and that's when things are more positive. We keep an eye on the Dow and then the transports. We see the Dow is close to an all-time high. The transports, which are in red here, continue to chop sideways. And then I was watching this back in January, the bank ETF. We want the financial sector to do well. That's it gave us some signals that things were not looking all that good back in 2007, going into 2008, and then we had the great financial crisis. So we watched the charts of that area. Plus, when the financial sector does well, the market does well. Now, we want tech and growth to do even better. And if the financial sector starts to overtake growth and tech, then that tells us that the overall climate of the market is shifting. But we're not seeing that right now. But we still want these areas to be doing well. When we drop below the 50-day moving average with the bank ETF, that was causing some concern, but then we were able to get back above it. And since we're above it right now and still in a longer term uptrend with the blue line above the red line, I haven't been showing this. This is another area that we look at within the financial sector. We look at the regional banks, the smaller banks, and do a ratio with the financial sector itself. Not showing a lot of strength right now, but not really breaking down either. If this really starts to fall like we saw, this was when Silicon Valley Bank and Republic Bank, when they were like, uh-oh, something's wrong here. That's when this ratio really went down. We just want to keep an eye open to see if something like that happens. When interest rates have been going up like they have been, that can pressure small banks because a lot of these banks and a lot of people that they loan to, they're going to have to refinance and buy new bonds at higher interest rates and sell bonds, and higher interest rates can really have an impact on small banks. So that's why we're keeping an eye on this. And we look at the staples to tech ratio, and there's times when we're really moving with this ratio. I'll show it every day, but we've been just chopping around. But for the most part, staples have been underperforming tech. Staples are more defensive. That's what the market gets into when it's getting ready to go down. You can see back in 2022, staples were outperforming tech. As long as this ratio keeps going down, that's more positive, meaning the tech sector is outperforming, and that's what we want in a positive environment. Then I look at the QQQs. This is the ETF for the NASDAQ 100. Getting a little bit concerned a few weeks back when we were dropping below the 20 and 50 period moving averages. Well, now we're comfortably above them and getting really close to this previous all-time high. Everything is still in a solid uptrend, so I haven't been showing this chart. Then we look at a broad market measure. Stocks on the Amex, the American Stock Exchange, the NASDAQ, and the NYSE, and take a 5-period moving average of their highs minus the lows. We're above zero. That's the real takeaway from this. So in the broader market, this is showing that in the internal strength is still there. These are just for information. These are rated change charts. It takes Friday's close, goes back 250 trading days, and says, okay, what's the difference between the two? We've been coming down a little bit as we finished out 2024 into 2025, but it's still hanging in there. And we were getting a little bit concerned because we had gone above this blue line. And that's when things were more positive. We're coming down right now. It's not necessarily negative, but it is mean that we're not showing that extreme reading that we were getting before. It would be more positive if this chart was to turn and start to go back up. Then we keep an eye on bonds, and I do show these in the what to watch video because this is something that I'm watching, is the interplay of interest rates and how they impact not only with cash in this chart, but how they interact with stocks. And this is cash, which is the 1 to 3 month T-bill, because you get virtually no interest on that. And then doing a ratio with a 3 to 7 year bond based on price. In a general sense, when this is going up, that means the market is more concerned about interest rates going up and inflation going up. And that's what we've been seeing lately. We'll see if this can start to come down, but this is causing a little bit of concern on a short-term basis with the market. We do that same thing with TIPS, which are Treasury inflation protected inflation protected securities. And these adjust for inflation and for interest rates. And when people want to get into this is when inflation and interest rates are going up. Well, when interest rates have topped out and they're starting to come back down, people don't want to get into TIPS. They want to get into 3 to 7 year bonds that have a locked in interest rate. Well, this has been going up since the beginning of 2025, and because there's some inflation fears coming back into the market. We're still in a downtrend with this ratio, but the longer we stay above both of these lines, the more this could turn back into an uptrend. This is just something that we're keeping an eye on. That same thing applies to tips to 7 to 10 years. The previous one was 3 to 7. This goes further out. And this is showing, yeah, there's some inflation fears and uncertainties about interest rates coming back into the market now. And if you follow much of the financial media or follow any information sources, there's some concerns. We're seeing the CRB index, which are commodities, they're in uptrends right now. Interest rates have been going up. And there is some concern about that. Now, stocks can go up when interest rates are going up. But when interest rates start to hit a certain level, and who knows what that level is, we call it a tipping point. When they finally get to the point where stocks say, okay, I'm not comfortable with this anymore. I was okay when you were under 4.5% with your interest rate. Once you get over 4.5%, now I'm not feeling comfortable about that anymore. And it's starting to annoy me. Now, I don't know. I just picked out 4.5%. That's kind of the level that we've been dealing with lately. But it could be 7%. It could be 2.5%. It changes depending on the market climate. But we're a little bit concerned about this, and we'll just have to see if this ratio can start to come back down. Then we look at the long-term bond ETF based on price. That's in blue. And then the S&P 500, and do a long-term correlation, which is pretty much flat right now, and a short-term correlation. Are they moving in the same direction or in opposite directions? It's kind of neutral right now. We're not getting a real high reading, but we're not getting a real low reading. If we get a real high reading, that means they're going in the same direction. If we get a really low reading, that means they're going in opposite directions of each other. That same basic thing applies to the Qs, the NASDAQ 100 and the long-term bond ETF called the TLT. And we're seeing a bit of an improvement here with the correlation, meaning they're having a slight tendency to go in the same direction at the same time. Then here's another look at a relationship between the US and things in Germany. We take the 10-year yield and subtract the German 10-year yield. That, because US rates are higher, that gives us an answer above zero. And then we plot the US dollar index down here. And believe it or not, there's a pretty strong correlation between the two. Now, we don't really make decisions based on this. Is if we start to see this correlation wear off and get down into this red area, that's when we're kind of like, okay, what's going on here? Usually, most of the time, we see the correlation pretty high. If it starts to get out of line with each other, then we're trying to look to say, okay, what's making this correlation break down? All right, then we keep an eye on the 2-year Treasury yield. That's shorter term. Not really helping us right now as the 2-year yield has been chopping sideways. And as I said earlier, we've got European stocks, specifically in Germany, hitting all-time highs. Well, just to really make it kind of crazy, we look at the Eurozone ETF, stocks in Europe, and do a ratio with American bonds. How's that? Well, you can see that the Eurozone stocks are really outperforming 3 to 7 year bonds right now. And this just means that market is pretty strong, stronger than the price of 3 to 7 year bonds in the US. Then I have these things called possible positive scenarios. I talked earlier about 2022. That was the bear market that we were in. And I pulled out a number of different charts and studies that I used during that time. Because when we're in a downtrend and we're going down, but maybe we've gone down too far too fast, we might be looking for some kind of a bounce. And that's what I call possible positive scenarios. I've got a number of different charts that we use to confirm, are we actually bottoming and due for a bounce? Maybe not switching back to positive, but maybe something where we can do some short-term strategies to benefit from things going back up. Well, a lot of those charts I use in the video every day. Other charts I include in this video here. The first one are the percent of stocks inside the S&P above their 200-day simple moving average. Now I have another chart in the daily video that's the same thing, but it's a bit of a different context. This uses it like an oscillator, where we're looking for an extreme positive or negative reading. We're not getting that. Are we above or below 50? We're above 50, so that's positive. And that's as far as I go with this particular chart. That same basic idea with those stocks in the S&P above their 50-day moving average, which is intermediate term. Also, we had dropped down below 50. Now we're coming back above 50, not getting an extreme positive or negative reading. Mid caps dropping a little bit below 50, looking weaker. This is one of the weakest indexes for the time being. It's like small caps and mid caps trade places ever so often. Not an extreme positive or negative reading there. And the small caps also dropping down below 50, not extreme positive or negative there. Then, and there are times back in 2023, I was showing this chart every day. Well, we've been just chopping around right now. This is a ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming utilities. When this is going down, that means the S&P is underperforming utilities, and we've just kind of been chopping around lately, so we're not really getting any additional insight from this chart. Same thing here with the staples. Now, we're seeing a downtrend overall, but lately it's been bouncing back up back in 2025 as we get into the new year. This is a little bit of a concern. In fact, I did show this in Friday's video, but overall we've been declining so much and the trend hasn't really changed. But we're going to be keeping an eye on this. If this really starts to go back up, that could mean that the overall characteristics of the market are changing to get more defensive. If this starts to go back down, that means this ratio will continue to decline, and we're typically more positive at that point. So thank you. Have a great weekend, and I will talk to you in the next video.